Our next guest says the fear of inflation is greater than inflation itself. Let's bring in Eva Ados, COO and Chief Investment Strategist at ER Shares. Eva, always great having you with us. And of course, we saw U.S. consumers' expectations for inflation now jumping to an 8-year high in July. And this is even before they factored in the infrastructure deal. How will this reverberate through the markets?
That's exactly the story. We think that the fear of inflation is greater than the underlying inflation itself. We are seeing, of course, many cases where there is a demand pull and cost push inflation scenario, but there's no big surprise here. The Fed is being very transparent with their announcements. We also have analysts and economists around the world tracking every little variable when it comes to inflation. We have to remember we are coming out of an extended period of historically very low rates. So in some regard, we have gotten accustomed to near zero rates, which is not the case previously. So that doesn't mean we should underestimate the significance of the fear for inflation, because that's what drove the markets down earlier this year in February, when we saw high growth stocks dropping significantly out of fear for inflation, which was then shown to be unfounded. So of course, inflation is here, but the fear of inflation and the expectation of it is even worse.
Eva, it's not really that bad, right, when it comes to how investors are fearing inflation and how that's playing out when it comes to the markets. Because take a look at this chart, for example, buying the dip, the S&P 500 hasn't been over 5% off its peak levels so far, because we are clearly seeing investors still hopping in every time there's a little bit of a sell-off. So how long can this be sustained if you believe that markets have priced in inflation, have priced in, a gradual Fed tapering, and have priced in lockdowns not happening even with Delta?
So we are mostly concerned about the rising Delta variant cases, because what that can create is further supply chain disruptions. It can wreak havoc when it comes to supply chain disruptions. And we are already seeing manufacturing facilities in Southeast Asia closing their operations. They are shutting down their plants. They are scaling back on their production. That can reverberate across the global supply chain. And it comes on the heels of a tenuous comeback from the 2020 COVID issues. So we already have supply chain issues in place. That's going to further exacerbate and further tighten the product availability and push the prices higher. So we'll see even more cost push scenario inflation going forward. It's adding fuel into the inflationary concerns, which are already very pressing. We have increased governmental spending. We have wage inflation, cost push, and demand pull inflation going on.
Still with us is Eva Ados, who's the CEO and Chief Investment Strategist at ER Shares. Eva, thanks for sticking around with us. Look, agree with him or not, it's hard to argue that this idea of cognitive dissonance when it comes to Chinese stocks and how they're perceived by investors or certain investors, it's something that's been very observable, right? If you do agree with him and say that, yes, these shares should fundamentally be trading at a discount because of that risk, how steep does that discount have to be for there to be a compelling buy opportunity?
Well, as it usually happens when there's a mass exodus out of an asset class, there are opportunities created because some very desirable, good growth stories are getting hit along with other stocks. And that's the case right now. We have some good growth stories that have a lower valuation. Some contrarian investors are finding good buying opportunities. I'm not saying that all of them are a good play, but there are opportunities there. We also need to have in mind that China has not abandoned their long-term growth-oriented capitalistic intentions. There might be a big difference between valuations in the U.S. So the valuations between U.S., China, and the rest of the world has widened. That has made the risk-return case much more compelling. The risk is real. The risk is justified when it comes to Chinese investments, especially when you have sudden announcements by the Chinese government. But it doesnn't mean that his...
So do you play along with those sudden announcements? Is GTV chart on the Bloomberg showing how some sectors have really rallied, given that people are thinking, wait, there are sectors that will benefit from Chinese politics?
We are tracking the sector. Some of them, as you said, will benefit. Of course, every announcement has its good side and its bad. So it needs to be a stock picker's market. So there are good opportunities there. We saw educational and fintech companies getting significant drops because of the announcements we had lately. But that created other opportunities in other areas. And also the significant drops are also good buying opportunities for the long term. So for contrarian investors who are looking long term like us, examples like Futu and UP Fintech that have dropped 45% from their highs are very good buying opportunities. They have Futu has one of the biggest growth stories. It's one of the highest growing company out of the 60,000 companies we are tracking around the world.
Eva Ados, always great getting your insights. Thank you so much. COO and Chief Investment Strategist at ER shares with her take on the Chinese market.